Thank you, everyone, for attending our webinar today, where we will be talking about the very exciting changes that happen, or at least exciting to us who are transfer pricing practitioners, the latest changes or milestone changes to the Malaysian transfer pricing landscape. So some of you may be familiar with the fact that the transfer pricing provisions in Malaysia change as of end of May 2023, with quite a bit of significant changes, which we will go through today, that I think every Malaysia taxpayer should keep in mind, because what it means is that some of the requirements are more stringent and everyone has to be a little bit more proactive to be ready. So you can post any questions in our Q&A box, and we should be able to answer them at the end of the webinar. Before we get started, let me just do a quick introduction. For those of you who don't know us, our firm specializes in providing practical, proactive, and cost-effective transfer pricing advisory to multinational companies in Asia and around the world. We have 3 offices: our office in Australia, Singapore, and Malaysia, from which we serve all type of multinational companies in the region. And obviously, as because of having presence in the region, these changes to the Malaysian landscape are very important to a lot of our clients that have operations in Malaysia, which is actually quite a big market in the Asia Pacific region. Just a few points on information and our educational accolades and award accolades. With that, let me just go into the detail on our presenter for today, who some of you already know him, Hon Chuan Tan, who is our technical leader in Malaysia and director with over 10 years of experience in consulting multinational companies in the area of transfer pricing, and also quite experienced in setting up transfer pricing practices prior to us with one of the big mid-tier firms in Malaysia. And now we're lucky enough to have him for now 5 years plus with us as the director and the leader in our Malaysian office. So some of you who don't know me, my name is Adriana Calderon. I'm the technical lead for Singapore and Asia, co-founder of Transfer Pricing Solutions Asia and Malaysia, together with Mr. Hon Chuan Tan over here. I have extensive experience in the area of international tax with Big Four and mid-tier firms working in different regions, and over the past 15 years in transfer pricing in the Asia Pacific region. With that, maybe we get started, isn't it, Hon Chuan? So you want to do a quick recap of what is transfer pricing in Malaysia?
Yes, thanks, Adriana, for the introduction. So before we go through the new changes, I think it's good to actually recap and refresh what's CP in Malaysia, right? Do a refresher, and then we go through the new changes accordingly. Now, TP in Malaysia is very similar globally, where we follow the OECD guidance, where it surrounds the main principle we look at, which is the arm's length principle, right? So this arm's length principle, it revolves, substance-based, which is like your economic commerciality, commercial reasons-based, as well as looking at the arm's length price. Right, a lot of people will be asking us, what's that arm's length price, right? So in layman terms, it's basically the price that independent party within similar circumstances as your visitor party would transact with another independent party, right? So that's the so-called arm's length price. It may equate to your market value, so that is to be tested, right? So which brings us to the last point, which is, in order to prove this compliance, right, taxpayers will need to have prepare and maintain a contemporary TP documentation to be able to explain why your price, your related party pricing are at arm's length. All right. So on the next slide, we're going to look at in Malaysia who must prepare it. In Malaysia, for all taxpayers that has entered into any related party controlled transaction, you are required to prepare ATB documentation. And now in Malaysia, it includes both cross-border as well as domestic transactions. I know some of you'll be looking at the domestic transaction part where, hey, it's in and out, but there will be an exception for domestic transactions where if you're able to assess that you're both accessible and chargeable to the tax in Malaysia, and any adjustment made will not alter the tax payable or suffered by both persons. So in layman terms, if you are loss making, if you have enjoyed tax incentives, and if your effective tax rate is not the same between both entities, then you need to cover the domestic transaction as well. All right, so bear that in mind.
Thank you, Hon Chuan. So maybe we can talk a little bit about the type of documentation that we have in Malaysian and how they apply.
Yep. So as I mentioned earlier, anyone that has a control transaction will need to prepare a TB documentation. And in Malaysia, we sort of have a leeway for taxpayers that have smaller operations, and it's mainly based on a quantitative based threshold, right? So the first threshold would be if you have an annual revenue of above 25 million ringgit, and if your total related party transactions is above 15 million, then you need to prepare full TB documentation. Or the next one is if you are not a bank, a financial institution, and you're providing more than 50 million worth of financial assistance, then you need to prepare a full TB documentation to test this financial assistance, right? So for those taxpayers that fall below this threshold, then you can opt to prepare a minimum TB documentation where it will have much less detailed or compliance burden that you may have when you prepare full TB documentation. Now, we're not going to go through in detail the difference between a full or minimum. The main difference would be that the minimum would have much less detail put in place.
Yeah, and I think we're going to cover some of the changes that are coming from these as well, for particularly the minimum TP documentation and even the full documentation as well. So why don't we finalize with talking about some of the benefits of documentations and what are the current penalties for non-compliance before we go into the detail of what are the key changes?
Yeah, I think it's good to look at the benefits of having a TB documentation. I think in Malaysia, I think we have evolved a lot in TP. We have gone from taxpayers not really wanting to prepare TB documentation and now sort of being forced to have the TB documentation. Now let's look at what's the benefit. What are the benefits? The first part would be your penalty protection. That is the main part of having a TB documentation, where when you have prepared comparative TB documentation, straight away you have a penalty protection. I'll go through later on, failure to furnish your TB documentation to the RRB. And next, it reduces the risk of an audit and dispute with RRB. When you have a quality TB documentation in place, when RRB requests for a TB documentation and when they look at the TB documentation, it may not lead to a desk audit or a site audit or any litigation from the RRB, right? And what the TB documentation does is that it sort of provide an overview, a story being told to the RRB, what's your transfer pricing position for your company. And in that regard, it will also minimize the penalties in the event that the IRB wanted to make an adjustment. You have your justification to be done using your TB documentation, and it will minimize the penalty. And Second last, recognized as a good practice. IRB has, I think, time and time again, sort of emphasized that they see it as a good effort by taxpayers to prepare a contemporary TB documentation. And on top of that, now it goes beyond TB documentation. It will be good to have your intercompany agreement, your contract put in place and formalized. In the event that IRB comes in, request for any documentation, and you provide all this documentation to IRB, that act itself would be a good provide a good assurance to the IRB that hey, you actually looked at your TP, and that they wouldn't spend that much effort or in detail to look at to scrutinize everything that you've done, right? And lastly, planning tool. I think a lot of taxpayers, they are looking at TP documentation as though it is just a compliance based requirement, right? But if you look at the TP documentation, it can actually be used as a planning to sort of relook at your supply chain, within the group as to how best you can recharacterize any of the risks within your supply chain. Maybe use that as the TP documentation to then decide on whether there would be a change in the supply chain to better manage both your tax as well as your transfer pricing position. So these are the benefits that you would have when you have a TP documentation.
Thank you, Hanchan. Let me just continue with the penalties before we move on to key changes.
Yeah, so the penalties for non-compliance, the major part would be that failure to submit TP documentation within 14 days, 2 weeks, upon request. Then the penalties are between 20,000 ringgit to 100,000, or imprisonment of up to 6 months or both, right? This is for the directors involved. So that's the penalty protection I was talking about earlier. And the next step would be non-compliance with arm's length principle, right? When you have a TP documentation in place, but then your TP documentation are not able to fulfill or test the arm's length principle, then you have additional corporate tax payables, penalty ranging from 20 to 50% on tax payable, as well as a surcharge of up to 5% on TP adjustments, right? Regardless of whether you're in tax losses or not, the IRB will be able to collect 5% upfront based on the TP adjustments.
Thank you, Hanchan. So let's move on to what are the key changes that were implemented from May 2023. So we have divided into 3 key areas. One is some of the administrative changes. 2 is additional disclosure requirements. And 3 is the arm's length range, the median, and the comparability analysis. So let's start with the first one, which is the administrative changes. And Hanchan, could you please take us through what are the key administrative changes?
All right. It's always exciting to see IRB, be looking at the TP. Unfortunately, there are some changes that they haven't put in place, which we were waiting for example, the safe harbor. But let's look at what has changed post 29 of May, end of May 2023. And main thing is we need to look at the effective tax rate date, which is from YA 2023, right? So in YA 2023, you need to make sure that your TP documentation would have all these rules in place. And the changes now involves contemporaneous means, not later than the tax filing due date. I mean, this is obvious because we have a lot of changes on top of just the TP documentation. There is an introduction of the tax form as well, right? So when you're preparing an income tax return, you have the tax form, a real party form in place that you need to fill in, right? When you have real party, that will need to be then submitted during your income tax return. So which means that before you submit or lodge your income tax return, you would by right need to have a transfer pricing documentation in place in order to actually fill in those figures. And lastly, now the transfer pricing documentation, I think it reflects what's happening already in Singapore, where you need to include the date of completion when you first prepare and complete your testing of the transfer pricing documentation.
Okay, thank you, Anchuan. So I do have a few questions here that I think are quite relevant. The first one is, what is the year of assessment in Malaysia, and what are we looking at? Like, if you can give us an example, what is the effective year of assessment 2023?
Yeah. So I guess in Malaysia, the year of assessment follows the calendar year, which is 1st January to 31st of December. So effectively, this means that your TB documentation for 1st Jan to 31st of December 2023 will need to comply with this TP rules, right? So when you're looking at that will be next year when you start preparing your TP documentation for the YA 2023.
Okay. So 22, in other words, where it is working now in 22, this is the last year of the current requirements.
Yeah, that's correct.
Okay. And with this date of completion, there is a lot of debate even in Singapore as well on how it's going to be enforced. So two questions come to mind. The first one is, can I backdate the date of completion? Would I get caught if I backdate?
I guess that's the tricky part, right? A lot of people, I think everyone will be thinking, hey, date of completion, right? So when I can prepare it later on, but then if I just slap in the date of completion on my TB documentation, that should be fine. Because, you know, TB documentation is not lodged to the IRB. It's only upon request, then you'll be able to find out what the date of completion is. But I believe another way of what the IRB will be looking at is, in this digital era, right? They'll be asking for, you know, the digital format of your TB documentation. One of the ways that they will be looking at will be your date of modified, the last date that you finalize your TB documentation, right? The last date that you save as a PDF in your data in the digital bank upon request when the IRB comes in. So I think that's another highlight that we need to address, is to make sure that when you save your TB documentation, both hard copy or digital, right? Digital, make sure that you are saved properly, and make sure that all the personnel would know where you saved it in. Is that the same situation that you have in Singapore, Adriana?
Well, I have to say that the date of completion made a huge difference in Singapore for taxpayers to start preparing a lot earlier than before, because of the same reason that you're saying. So these days in Singapore, there is no desk reviews that are conducted based on paper. So when you get subject to an audit, actually the officer always requests for all documents to be sent digitally. So if that's the case, in our experience, what we try to do is to avoid as much, like to literally not touch the TP documentation, because the review is happening 3 years later from your financial year end. So we don't touch the TP documentation. However, it was completed 3 years ago, that's how we send it. Because we don't want a situation where IRS come and say, well, you modify it, therefore it's not contemporaneous. I think that's one thing. I think the second thing to be very mindful of is, if you're doing it at last minute and try to backdate it, there is a lot of ways to fall into your lie, because the reports are very driven by data, right? So for example, if by mistake you did it in a rush and you put some data that didn't exist 3 years ago, that's one way that you can fall into a trap. Another one is the searches. If you put data of the searches and something come very easily to say that you did it was 3 years when you were asked and not 3 years before, that is a very easy way to fall into the trap as well. So that's where the whole back date, whenever it is asked, is a bit of a challenging one, because there is a lot of, it's like Kayenga, you will fall in your life unless you really are like so good of a criminal that you have tied up all the knots to make sure that you don't fall in your lie. That's how I see it.
I think you actually make a very good point. I think in terms of not just the TP documentation, I think especially during an audit, where they're asking for more information, right? They can start looking at your email correspondences. When were you liaising with your personnel or the external consultant as to when you're going to prepare, when has that been prepared, right? That is, I think it's very hard to actually manipulate, to be honest, especially the email dates and the correspondences.
Yeah, that's what I'm saying. If you're choosing to be reactive and backdate, you better learn how to be a spot on criminal. So you tied all the knots
Right.
and don't fall into the trap. So you really have to make sure that is all like. So let's now talk about the changes on the content of the documentation.
Yes, I think the content is rather similar to Singapore, I must say. They have included a new group level information. Now, we're not strangers to this group level information previously, where when we're preparing a full TV documentation, there are a certain extent of group level information that has been incorporated into the full TV documentation. The point is the IRB has gone another level where it has gone from a normal basis to a more master file based group level information, where there are a lot more detail to be put into the TV documentation, thereby unfortunately increase more compliance burden for the taxpayers, right? So then we have the entity level information that cost contribution agreement or arrangement has been extensively put in place into the TP rules. It was in the TP guidelines, but then now it's actually embedded into the TP rules. Then there are indexes to documents, date of completion, as well as other supporting documents, including your any contracts or intercompany agreements that you may have, right? This all comprise the TP documentation.
So one question that comes to mind here, and I think is a challenge also even in Singapore, where we already have all these requirements 5 years ago already. So the question is, what happens if I don't have this information? What happens if I don't have access to this information on a global basis? So how one could potentially resolve that challenge?
Yeah, I think one distinction that the IRB specifically put into the TP rules is that they have mentioned that, hey, I have provided a list of contents that you need to put in place for your TP documentation. And if you are not able to actually provide any of the information listed in the TP rules, you need to then describe the non-applicability of any of the contents that you are not putting inside the TP documentation. So which means that first up, you already need to have a list of content, and then you need to do a cross-checking based on what you have in the TP documentation. And for those that are not within or not applicable for your TP documentation, you need to now actually explain why it's not in place within the TP documentation, right? So that's very important.
Okay, maybe it's worth also explaining a little bit this new concept of the group level information.
Yeah,
So
let's see what's in the group level information, where we need to disclose now a more detailed group level information that relates to your the multinational group. And because this group level information is rather similar, it's actually quite similar to the master file, then therein lies the decision whether the master file can be formed as part of this transfer pricing documentation. Because the head office, if you are actually within the country by country obligation, then your head office would have that master file in place that the local entity may be able to actually leverage from and actually use that to form as part of the transfer pricing documentation. So that's the key distinction. Now let's look at what's inside this group level information, right? If you look at the structure, now it involves going through the organizational structure, which is the group structure. Then now you need to describe your group's business. You know, it includes drivers of your business profit, your supply chain. You may not need to actually provide the important service arrangements as opposed to the master file, right? You can briefly describe what services are available within the group. And before I go to that, the main distinction of this group level is that you only need to include the information related to your Malaysian entity's business operations, right? So any other information that are not related to Malaysian business operations, you can actually not incorporate it into this group level information to your TB documentation. All right. Then we have your main geographic markets, a brief of FA to actually understand what's the functions, performed, risk, and assets employed for the group, as well as looking at any important business restructuring, acquisition, or divestitures within the group itself. Then we drill down to the group's intangibles in relation to the strategies, what are the intangibles in place and the legal owner, any agreements related to intangibles, TP policies in relation to these intangibles, and any transfers of intangibles that are happening within the multinational enterprise, right? So that's the key information for the intangibles. That's a lot more information that's put in place in the TPD now. And on the next slide, to follow up, now you also need to include any financial activities within the group, right? So any financial arrangements details that then you need to put in place. And lastly, then you need to actually incorporate your group's financial and tax position. So that will be your consolidated financial statements, as well as any APAs that's actually happening within the group itself. So if you look at the detail of this group level information, it is actually a lot more than is required previously.
Yeah, so a couple of points that jump into mind, but the first question is, would this group level information apply for full TPD and minimum?
Yes, so in the TP rules, it did not specify whether it applies to a full or a minimum TPD. I guess because the TP rules also doesn't specify the full and minimum. The full and minimum is actually within the transfer pricing guidelines, which I think they're revising the TP guidelines as they speak. So now we have gotten verbal confirmation from the IRB that this group level would actually just apply to the full TP documentation, right? If you are doing a minimum TPD, then you're not required to have this group level information in place.
And I think another point here that is worth thinking about is the difficulty of explaining ahead of is the level of detail that you have to display in the group level information. So that has been one of the biggest challenges in Singapore, whereby a lot of head offices are very reluctant to use the master file in lieu of the group level information, mainly because they want to make sure that sometimes they are not very open to disclose everything about the group in the master file in the local documentation. So a lot of the times that is a key driver for companies to decide to do their own group level information for Singapore or for Malaysia, because otherwise you will be forced to disclose a lot of information that maybe is not relevant for the local operations. So under those circumstances, some of the multinational groups will opt just to do their own group level information for Malaysia or for Singapore purposes, as opposed to using the master file in view. I think another very challenging point that people don't realize and is quite of a challenge is the annual consolidated financial statements, because before, unless you were willing, you were obliged to lodge the master file, the local tax authority wouldn't have visibility over the annual consolidated financial statements, but now they will. So that's something to keep in mind as well, because if the proportion of annual consolidated profit, for example, and revenue is quite disproportionate in comparison with the local operation, then it's something to look into and be ready for questioning. So those are some of the biggest challenges that we also have with this disclosure requirement. So I believe that this is something that should not be taken lightly, because the understanding the level of information that you have to disclose is quite critical, and how much you feel comfortable with disclosing locally. Okay, my favorite one, which is like a sui generis change, or Malaysia trying to be different from everyone else, which is the new definition of the arm's length range.
Yes, this is a huge change, to be honest, but at the same time, it may not be the bad thing based on my experience for Malaysia. Now let's see why. Okay, so previously, that there is actually no specific guidance or no specific provisions in the TP rules to say what constitutes the arm's length range, right? Obviously, based on OECD, we are looking at the interquartile range as the arm's length range, right? But then in Malaysia, there's no specific guidance as to what's the arm's length range. So which means that the IRB can go through hoops to say that, hey, that's not the range, or hey, I think the median is the range, right? So that's why previously, based on our experience, the IRB always falls back to the median for the rate itself. Now, the new range has gone from a interquartile range, which is 25 percentile to 75th percentile, to a 37.5 percentile to 62.5. So if you look at the diagram, it has actually narrowed down quite a bit, the range. So that can be good or bad. For the new rules, right, the IRB has stated, the rules have stated that if your transfer price falls within this new arm's length range, then there'll be no adjustment. If not, then the DG will be able to actually then adjust it up to the median, right? So another point that is trickily embedded into the TT rules is that, however, the IRB may still adjust the transfer pricing to the median or above if they think that your uncontrolled transaction or the comparability that is used within your TP documentation has a far lesser degree of comparability, right? The comparable companies that you have chosen is not in line with what you're doing. It's not comparable to your tested transaction, or there are other comparability defects that cannot be quantified, identified, or adjusted, right? This is a caveat that has been included within the IRB. So the rule of thumb is that when you perform the benchmarking analysis, you need to ensure that you go through the 5 comparability factors to ensure that all the companies that you have selected are actually comparable. And if still, obviously, IRB knows that there will not be any perfect circumstances or perfect company that will be the same as you, right? So the taxpayer's job is to actually explain any of these weaknesses in comparability to ensure that when the IRB comes in, then you actually justify your comparability. Now, first, I was saying that it may not be a bad thing. That's because previously, when there was no arm's length range per se, the IRB during an audit will always look at your median, right? So when your transfer pricing falls within the range, but then it falls below the median, they have the ability to actually then adjust it up to the median range or above, right? Median is always the point that they're looking at. Now with this range, as long as you fall within this range, no question asked, they will not be able to adjust it to median unless obviously it's less comparable. The comparable companies are less comparable, right? So these are things that you need to be mindful of.
So what is, in your opinion, the impact of this? I mean, apart from, I guess one big impact is having to look at the comparables again to first make sure that they're fully comparable and you don't have very weak links there. And then having to recalculate your range, right?
Yeah.
Because if you were too close to the 25th percentile or to a 75 percentile, the chances are that you're going to be outside of the range.
That's exactly correct. There are a lot of impacts, pre-rules and post-rules, where if you're prepared, because we are prepared 25th to 75th, right? And before that, and if it falls between the 25th to the 37.5, then you need to be wary that, because if your TP policy is of that nature where there are certain analysis that dictates using the lower quartile instead of the median, for example, depending on the characterization of your company. All right, depending on analysis, where the TP policies actually use the 25th percentile as a basis for your arm's length rate, then the impact is huge, because then you really need to relook at the range itself and really reassess your TP policy for the group and ensure that the rate falls within that 37.5 and 32.5 range, right? So that is the huge impact, and you really need to reassess your TP documentation, your TP policy again, to ensure that when you prepare the new arm's length range, and you need to then make sure you fall within that range, the new range.
Okay, so definitely lots of things to look at when updating all the ranges next year, right?
Yeah, definitely.
2 seconds. I think my computer is giving a little bit of trouble to move to the next slide.
Yeah.
Okay. Here is
actually,
the example.
Yes. Yeah, I think it's good to actually illustrate what we're talking about in terms of the new range, the old range and the new range. So previously, if you look at the range itself, it goes from 7.46% to 10.28 with a median of the 50th percentile 8.77. With the new range, we are looking at 8.42 to 9.87. It's really narrow. I mean, this again, as a caveat, this is in no shape or form from any of our benchmarking, just some random numbers that's put in place to actually, for the purpose of calculating the interquartile range as well as the new range itself. So if you look at the impact itself, where if your rate falls, at between 7.46 to 8.42 previously, then you really need to bear in mind that you will fall out of the arm's length range in 2023. And it's really good to look at this now, because we are looking at 2023. So which means that you'll be testing your 2023, which is this year. Right? What's happening this year? Your TV policy is actually 7.46 to 8.42. Then you really need to relook at your TV policy and make sure that when come the preparation of TP documentation for 2023, FYE 2023, and to test the rate or the margin or any analysis that you've done, making sure that your PV policy, the country PV policy, will fall within the new arm's length range as illustrated here, which is above the 8.42%. right? So that's very critical in my opinion.
Yeah, it is. I do understand your point that you don't mind this 2023 because you will be facing, regardless, I believe that if the comparables are really comparables, you will be dealing with a narrower range.
Mhm.
Unless you're putting as comparables everything under the market and then
Yes.
you're putting everything. But I guess I don't know about you, but I do find that when you have a narrower range, I think there is a correlation between narrower ranges and reliability of the comparables. I think when the comparables are reliable, the general outcome is a narrower range, and that's why we, even in our practice, sometimes we tend to have a bit of a disbelief with very wide range, right?
Yes, definitely. There's a correlation between
Yeah.
comparability and the range itself.
Yeah. If it's too narrow, wide, usually you tend to think that there is comparability problems in it.
Mhm.
Okay. So why don't you give us some insight on the offsetting adjustments,
Yes.
changes and
So,
comparability analysis?
so for offsetting adjustments, it's also termed as corresponding adjustments, where previously there is a provision in place to say that any adjustment made by IRB, the taxpayer could then request for offsetting or corresponding adjustment from the counterparty, right? So especially for a domestic transaction where, hey, you adjusted me upwards for this entity, right? I would like to have an adjustment downwards for my counterparty, right? So that would then be fair and net off any adjustment that you made, right? And under this new ruling, the whole paragraph is gone, right? That's taken out, and I guess they don't see, or they don't allow, or they don't recommend having any corresponding adjustment in place, right? Because I mean that will be their burden, right? And this will very much impact the domestic transactions where in the event of an audit, the IRB will be making adjustments upwards, for example, right? Then you have no avenue to then apply or request for a corresponding adjustment to then net off that adjustment that has been gone down upwards. So that's a huge impact in the group point of view, where you have increased penalties, but then you have no way to actually reduce it by doing a corresponding adjustment on the other side. You're muted.
Yeah, 2 seconds. I'm just trying to, again, all right, go with comparability and what's some of the changes.
Yeah, it's quite similar to the previous one. The main change is that now previously there are provisions that say that, hey, you can use a year, and you can actually use the multi-year average as well on the basis that if your industry is of different life cycles, that may be justifiable. Now IRB has included that as well, but it's only used for the selection of comparable. It cannot be used as a way to calculate your multi-year average and use that weighted average as a basis for testing your rate. So it goes from a multi-year to you can only rely on a year-on-year basis, right? So bear that in mind that when you have analysis that actually keeps using the weighted average as a basis to test your transaction, now going forward, you need to use a year-on-year basis.
One question that comes to mind here is, so what happened, because TP audits happen usually a few years down the track, right? It's not immediate. In Malaysia, I believe it's 7 years, open years, right?
Yeah.
So what would be the type of data that IRB will use for conducting the audit?
Yeah, there seems to be sort of a mismatch per se, because with the new rules, contemporaneous means before the end of the before you lodge your income tax return, right? That's the definition of contemporaneous. But based on an audit, so what the auditor would do is that they will use the latest available data at that point in time, right? For the year on year, and making sure that you have you're using the latest year 3 years down the track, the latest available data at that point in time to test your benchmarking. So this means that when IRB comes in and start requesting for your TB documentation, one thing that you need to do is actually relook at your benchmarking, do a sanity check, especially those that at that point in time, there may be analysts that they have no financial information, for example, right? Therein, you have a different rate if you have financial availability of financial for the comparable companies. Do a sanity check, making sure that all financials are available. If they are not, that's okay. If they are, I think you need to recalculate your range and making sure that it is you still stay within that range.
Okay, so quick question here on these multiple years data can only be used in the selection of comparables. So what does that mean? Can you give us a little bit of an example?
So how it works is that, especially those in property industries or construction industries, where every project based on completion of projects, then only revenue kicks in and whatnot. So based on that scenario, what you can do is that when you are selecting comparable companies, you need to then look at what phase or what stage that comparable companies are at. Some companies, they may be a startup company when they're actually just having projects in place, they're starting up property development, and as opposed to companies that has already completed a lot of projects and are well into the mature stage of business operations and at the growth level, then you really then need to decide which year would be more appropriate or more comparable to your company's point of view, right? Based on the number of projects that you're in, the life cycle of the project that you guys are in. Therein lies, then you can use the respective years that you believe is more comparable to your year of assessments results.
Okay, thank you, Hanchan. So before we open for questions, let's just maybe we can just summarize all the key changes, so for everyone just to get some key takeaways from this session.
All right, let's go to the list. Yes, new rules 2023 onwards, which is the 1st Jan to 31st December 2023. Contemporaneous will be prior to tax return filing. And then now you have your group level information. You need to include your date of completion. You need to indicate non-applicability in your transfer license documentation for the list of content that is required to be in the TP documentation. And the arm's length range has gone from an interquartile range to a 37.5 percentage point, 62.5 percentile. And for TP adjustment purposes, there were no specific provisions in place, but based on our experience, it's IRB will almost look at the median and adjust you upwards to the median. And now with the new rules, there will be no adjustment if you're within this arm's length range, and adjustment to the median if you're outside. And if you have comparability issues during the audit, and depending on justification, the IRB will be able to actually adjust your rate to the median or above. And then now we have no corresponding adjustments in place or no provisions in place. And lastly, used to be multi-year average that can be used. Now we can only use a year on year and only able to select the comparables using the multi-year average, multi-year comparable data.
Okay, so thank you
Okay,
for that. We do have quite a bit of questions. So let's move on to the questions, see if some of them we already answered them or not. I look at a couple of them and I think they are already answered. Okay, so the first one is, Mr. Tan, what you think the justification of putting the date on the TP is? If my TP is dated just after filing deadline, does it mean that the company will be subject to penalty even if the TP is available?
Yeah, I think the IRB has put a lot on emphasis on contemporaneous, right?
Mm.
When it is not contemporaneous, based on the definition before the filing date, then by right, you will be subject to certain penalties because it's not really contemporaneous anymore, right?
Mm.
So that's the main point, contemporaneous.
Yeah. I think this one we already answered. Does minimum TPD needs to include group level information? And I think we have already mentioned no.
Yep.
Or it seems that is no. The disclosed group level information, what happened if the group HQ in their local region is not maintaining documentation as they do not meet the local threshold requirements?
Yeah, that's the challenge that you have, Adriana, right? I think it'd be good for your experience since you have done it a lot for Singapore.
Yeah, I think that's always that happen in Singapore, that I think they are not maintaining because we have some thresholds that in my opinion are not suitable for a country that has so many regional HQ. So I think in those scenarios, there is a lot of duplication because HQ is not taking it seriously. So they end up doing like local documentations, and then next thing they know, they are paying like for many things that could have been done more centralized. And then basically they end up at the end realizing that they have to find a more efficient way to do it in the first place. So I guess if your HQ is not taking care of it, you may want to tell them first whether they can start preparing and taking care of it. If not, unfortunately, it's going to be in the local operation, meaning the Malaysian operation, to do the hard work and get the documentation done, including the group and the entity level information. If my transfer price falls outside the arm's length range, say my case is above 72.5 percentile, will my transfer price be adjusted to the median?
Obviously, IRB will not do that. They will look at your counterparty to see whether they're actually outside the arm's length range. So, but bear in mind that if you have this kind of situation, it's good to then relook at your TP policy and say, hey, okay, in Malaysia point of view, maybe that's good, but what about the counterparty? Transfer pricing is all about not just one-sided, it's both-sided, right? But yeah, your question, they will most likely not adjust it to median, right? Because that's favorable to Malaysia anyway. They won't do that.
I'm guessing here that the context is that is benefit Malaysia, right? Because if it doesn't benefit Malaysia, then it could be adjusted to the median. If it's a payment that I'm doing for a price that is falls outside, then there could be an adjustment. Based on the TP 2023 rules, does it imply that the TP documentation, including the Simplify, are required to prepare a yearly basis despite that there are no significant changes in the TP policy?
Okay, so the rules regarding this has not changed, right? So TP documentation to remain contemporaneous will still need to be reviewed annually, right? Even though there's no changes in the business operations structures, but then you still need to relook at your economic analysis and update your economic analysis to make sure that it still stays within the range for that particular income year, right? That is to both satisfy your contemporaneous as well as the arm's length principle, so to speak.
Yeah, I think now this is even a misconception in Singapore all the time, that people don't understand that you really need to look at it yearly. That's what it is, because it's part of the tax return. Yeah, and then some point here is like the director is the one who signs the tax return. I think he should be happy for anyone to do it on a yearly basis, because if there is something wrong or if there is a misstatement in the tax, you can even have a penalty of imprisonment. So I think there is a very good interest in the stakeholders to really get it done, because if your TP has as a consequence a misstatement in your tax return, you can really be in trouble as a director and the public officer of the company. If my company year-end is June 2023, when perform benchmarking the latest financial information available for comparable only up to 2022, can I still use weighted average of the past 3 years?
Yeah, I think we all know that there will always be a a year lag between the latest available years for that particular year, because of the the submission of financial information to the company's commissions, and for it to be made public. Then the question is, what data do we be using, right? So based on the rules, you should be using the latest available data on a year-on-year basis, right? You can't rely on the weighted average anymore. You still need to use the year-on-year data, and the onerous is that it's the taxpayers' burden to ensure that your analysis use the latest or the up-to-date information to make sure that it remains contemporaneous.
Thanks. If we do TP-Doc for tested party, can we use the same doc for the counterparty? That means preparing one TP-Doc for two companies, assuming both in Malaysia.
Depends on the transaction. If it's just one transaction between both parties, you can actually indeed use it as the same TP documentation, because you need to assess whether the counterparty may have other transactions in place with other related parties.
Yeah, I think that's a key. With the major changes in Malaysia, would this mean that one report cannot be used for 3 years, though no material changes in the functions, pricing, transaction? We already, I think, discussed this in this, because there seems to be a misunderstanding here. At the moment, there is no countries that you can keep doing only every 3 years. It's every year, right? It's just that the update, if there is no changes, that is simple. But if there is more changes, then it's not that simple. If there is more transactions, etc., it's not simple. If it's the same transaction, then probably it will be limited to financial update, basically. But there is not a 3-year rule.
Yeah.
It has never been in Malaysia, right?
No. I think that, there's a misconception there in saying that, hey, 1 year can be used for 3 years, but actually each year will need to be compliant every year, right? You can't have one report that can be used for 3 years, right? If you look at the arm's length principle, it doesn't make sense, because you can't use 2019 to actually test against 2022's TP position, right? Yeah. We have COVID situation happening, so that's why it needs to be looked at every year.
It is okay to reject comparable companies that have abnormal out-of-range results? I think no. When you are rejecting companies, you have to do it based on your comparability, not based on the result. So based on the result alone, no, it has to be based on comparability, the rejection reasons. Otherwise, you could be deemed to be cherry picking. With this change, it seems very difficult to manage TP risk in Malaysia. The rule seems very prescriptive and does not seem to recognize that business itself is not so simple. Have the taxpayer provided feedback to the IRB? I'm sure, but to be fair, I think Malaysia is kind of catching up with some of the things that have been already in place in other countries, right?
Yeah, this is always a challenge, right? Especially for those that are below or small business operations. And now the new changes still affects the full TP documentation more than the simplified one.
And there is one comment which is interesting. Someone is sharing that in an MIA training yesterday, IRB has mentioned that the new formula will be 3.5 percentile plus 62.5% divided by 2 instead of the normal median formula.
So this is, I think, what we have discussed last time with Joanna, right?
Mm.
So I'll actually want to reconfirm with the IRB again, because I understand where you're coming from in relation to the formula of the 37.5 percentile and 62.5 percentile divided by 2, because in the rule it says the midpoint, right? The midpoint of the arm's length range. But then that is where I don't understand, right? Because for those that have gone through a statistic course before, generally the median would be the 50th percentile regardless of the change in the range itself, right? So it may not, I wouldn't say it's called the median anymore, to be honest, right?
Okay.
Yeah. So it depends, because I think, if I'm not mistaken, they're using the value at the 37.5 percentile and the value at the 62.5 percentile and divided by 2, right? Generally, that's not how it works, because I mean there's a statistical formula behind it, but we'll need to then reconfirm with them that regarding the median for the midpoint of the range.
Interesting. There is one more. Will the 2003 revision enable the section 140 of the income tax are easier to exercise by the DG? I'm not sure in which context will that make the section 140 exercised by the
I guess regardless whether there's a revision, section 148 will always be exercised by DG. With the previous ruling, they already have the autonomy to actually adjust, recharacterize. They have a lot of power in place to adjust for the DG. So I don't see it as easier to be exercised.
Yeah, I think the exercise is there. It's just that, for example, if the situation is to adjust the price, they have more tools to adjust to the median point specifically, rather than having a dispute at a court level of what any point in the range is acceptable. I think, remember in the MIA conference on transfer pricing, one of the debates have been that in the past, the IRB has been challenged in court and have lost in court because of trying to adjust towards the median always. And the court coming from the angle that the law said that any point within the range is an arm's length range. So I think this is coming from the angle of allowing the IRB to be able to do adjustments towards the median and specifying as to why the median is the arm's length range, particularly when the taxpayer is caught out of guard and hasn't done the due diligence to prepare the report with a thorough comparable company. So I think that's where they are coming from, right? Because they have been challenged in court with this, and they have lost because their provisions didn't say that they can adjust to the median. Now they do. All right, so I think that's the end of our webinar. So if you don't mind, we don't ask for compensation, but we like people to like us and subscribe to our YouTube channel. Also, keep in mind that there will be some webinars coming soon. Next week, we will be talking about intragroup services. Then in August, profit split versus traditional methods. And then we will be doing a session on the new changes in Malaysia and a comparison with Singapore. Thank you very much, everyone. If you want to reach to us, here is our details in Malaysia, and see you soon.
Thanks. Bye.